Hi, this is Jim Harvey, president of Opus 111 Group, and welcome to our third video in our 529 Plan series videos. Today's topic is 529 Plan Account Taxation 101. 529 Plan, as we've covered in our previous videos, is a tax advantage account designed to help families save for a beneficiary's educational expenses. The rules for such plan, formerly known as qualified tuition programs, are defined in Section 529 of the Internal Revenue Code, hence the name. The basic premise is that assets in a 529 plan, grow tax-free, and withdrawals are tax-free as long as they are used for what are called qualified education expenses. 529 plans are a more tax-advantaged way to save for educational expenses compared with other saving vehicles such as Uniform Transfers to Minor Act or UTMA accounts or Unified Gift to Minors Act UGMA accounts, which do not grow tax-free. Here is everything you need to know about the tax treatment of 529 plans. 529 plans are offered by the various states, with each state determining the plan structure for their investments. Often a state income tax deduction for contribution is available if you're using your state's 529 plan, though a federal tax deduction is never allowed for contributions. We have a list and a document that we can send you, which is a state-by-state list, which I will show you briefly on my screen. And it goes through the state tax deductions and credits for contributions to 529 plans to determine what's applicable in your state. So as you can see, here's Alabama. There's 3 of them. There's 3 Alaska plans, actually 4. And so it just goes all the way through. So you can scroll through in your state to find out, how it's treated from a tax standpoint. Just a second. Earnings in a 529 plan grow tax-free and will not be taxed upon withdrawal as long as they are used for qualified expenses, as I mentioned. Tax-free withdrawals now include up to $10,000 per year per beneficiary for tuition for eligible educational institutions, K through 12 private, public, or religious schools. In addition, 529 plans are now permitted to cover expenses related to any registered apprenticeship program and have a $10,000 lifetime limit for withdrawals to pay down student loans. This $10,000 limit applies to a beneficiary of a 529 plan, as well as a $10,000 limit for each sibling. And I think that's very cool that they've added the apprenticeship programs, because not every kid is going to go to college. Some kids are going to become, electricians or plumbers or woodworkers or whatever. And this allows them to deduct the cost of any school, which puts them in a position to get into those careers. A 529 plan owner is able to withdraw funds from a 529 plan anytime for any reason. However, the earnings portion of a non-qualified withdrawal will be subject to income tax and a 10% penalty. Contributions and earnings are deemed to be distributed on a pro rata basis. That means that if you put in 10,000 and it's worth 12 and you start taking it out, you take out 2,000, then that percentage of the earnings growth at $2,000 increment will be subject to that penalty and will be subject to tax. Your original contribution amount, of course, is not. Exceptions to the 10% penalty include, number one, when the distribution occurs as a result of a tax credit adjustment. Number 2, when the beneficiary receives a tax-free scholarship or veterans, employers, or other tax-free educational assistance. Number 3, when the beneficiary attends a U.S. military academy. And number 4, when the beneficiary dies or becomes disabled. There's minimal tax reporting is required for 529 plans. Contributions aren't reported on your federal return, and because they're not deductible. And as of 2023, contributions of up to $17,000 or $34,000 for a married couple qualify for the annual gift tax exclusion. You can also front load a 529 plan with up to 5 years of that annual exclusion amounts at one time with no gift tax consequences. So, for example, if you as an individual wanted to make 5 years worth of that $17,000 contribution, you could put $85,000 into the 529 plan and not pay gift tax. If it's a couple, then it's $170,000. Upon taking a distribution, a Form 1099-Q will be generated and sent to the appropriate taxpayer. As long as the distribution was for qualified expenses, no tax liability would be associated with the distribution. The 1099 shows the total distribution amount, the portion allocatable to contributions, the portion allocatable to earnings in the event the distribution is taxable. There are other situations related to 529 plans that should not trigger adverse tax consequences. Amounts can be rolled from one 529 plan to another once during a 12-month period. The account beneficiary can be changed to another qualifying member of the family without tax consequences. If you're considering changing the 529 plan account owner, however, exercise caution. Most state plans allow for a change of ownership with no requirement about the relationship between the former and the new owner. Some state plans may only allow a change of ownership when the original account owner dies or in special situations as divorce. So you should pay attention to the state in which you are and track the tax laws appropriate. It's not always clear what constitutes a qualified educational expense. IRS Publication 970 is the primary source to determine the tax benefits for education, though it doesn't deal with every situation. Qualified education expenses include tuition, fees, books, supplies, and equipment, as well as expenses for special needs services. These expenses must be required for or incurred in connection with being enrolled or attending an eligible post-secondary school. Qualified expenses may also include the purchase of a computer or peripheral equipment like printer, computer software, internet access, and related services if it's primarily used by the beneficiary when enrolled at an eligible post-secondary school. Expenses for room and board qualify only if the student is enrolled at least half-time. Room and board costs are not larger than the greater of the amount charged by the school for living on campus or the allowance as determined by the school in its estimated cost of attendance, which they use for calculating financial aid. Please note, some states may not align with what is considered a federal qualified withdrawal for items such as K through 12 tuition or student loans. In addition, for non-qualified withdrawal, some states have a penalty or income tax recapture rule where a deduction allowed in 1 year may be required to be reported as income in a subsequent year if the withdrawal is for non-qualified purposes. Items that are typically considered non-qualified expenses include travel and transportation costs, not qualified even for out-of-state students for travel to and from campus during holidays, health insurance, not qualified even for a plan provided by the school, extracurricular activity fees, only tuition costs and fees are qualified. Additional activity fees are not, unless part of a required part of attendance. Student loan payments in excess of the lifetime limit of $10,000, and then application and testing fees. Preparatory fees are not qualified. Fees must be associated with the current enrollment. Well, this is Jim Harvey. We hope that this third series about Taxation 101 and your 529 plans has been valuable. To learn more about it or other topics that might be of interest, please visit our website at opus111group.com or give us a call at 206-283-2345. Thanks for tuning in, and we hope to see you next time.